Hello, and welcome to Your Money, Your Way. Before we begin, quick disclaimer. The information provided in this video is for educational and informational purposes only. It is not intended as and should not be considered financial or investment advice. All investment decisions involve risk, and past performance is not indicative of future results. Please conduct your own thorough research and consult with a qualified financial professional before making any investment decisions. The creators of this video are not liable for any financial losses you may incur. Is Singapore Airlines one of the world's most admired and prestigious airlines, secretly a ticking time bomb for investors? For decades, Singapore Airlines has been the gold standard of air travel, a global brand, a fortress-like balance sheet, and a reputation for service excellence. After the pandemic, they came roaring back with record-breaking profits and huge dividends. But the party is over. The latest numbers are in, and they paint a grim picture. Profits have collapsed by a jaw-dropping 58.8%, even though their planes are packed with a record number of passengers. How is that possible? Today, we are doing a deep dive into the perfect storm shaking Singapore Airlines. We'll break down everything from its catastrophic investment in Air India to the brutal price wars crushing the entire industry. This analysis will explore whether the stock's strengths outweigh its significant risks. Stick with me. Let's get straight to the numbers that sent shockwaves through the market. Net profit down almost 59%. That's a collapse from 452 million Singapore dollars to just 186 million. But here's the twist. Group revenue actually went up. Think about that. The airline is carrying more people than ever, a record number of passengers in the quarter. Their planes are nearly 88% full, and yet their profits have been decimated. This is a textbook case of severe margin compression. It's a classic value trap. So what caused this? It was a devastating three-pronged attack. First, and most importantly, is the albatross now hanging around its neck. Its 25.1% stake in Air India. This quarter was the first time SIA had to fully account for Air India's financial performance. The result? A staggering $122 million loss dragged directly onto SIA's books. The Indian growth engine is now burning cash. Second, the era of post-pandemic sky-high ticket prices is officially over. As airlines restored flight capacity, a vicious price war has begun, crushing SIA's pricing power. And third, while revenue per passenger is falling, costs are exploding. The airline's non-fuel expenses shot up by a massive 8.5% due to inflation. They are getting squeezed from both sides. Now, let's look deeper at the bear case because the risks are potent and immediate. The biggest problem is the Air India investment. It has devolved into a full-blown crisis. It's not just a financial drain. The catastrophic crash of an Air India jet in June of 2025, which tragically killed more than 240 people, created a direct, toxic link to Singapore Airlines. This event created what analysts call reputational contagion, tarnishing SIA's pristine brand for safety and quality. To make matters worse, reports have surfaced about deep-rooted culture problems within Air India's maintenance standards. This investment is now a 5-alarm fire. Beyond Air India, the airline is facing a minefield of other threats: intense competition, a weak global air cargo market, and global supply chain issues that have grounded parts of its fleet. That is the perfect storm. Okay, so if it's a disaster, why are some investors still interested? Why are some professional investors actively buying more stock? This brings us to the bull case. It is a powerful defensive argument. It's not a case for growth, but a belief that SIA is a fortress strong enough to withstand the siege. Their core strength is the dual brand strategy, the premium Singapore Airlines brand for high-spending travelers, and their highly successful low-cost carrier, Scoot, to dominate the budget market. This provides incredible flexibility. Next is their financial strength. They have a massive war chest with a strong net cash position of 8.3 billion Singapore dollars. But the most compelling reason for the bulls is the dividend. The stock has been paying a trailing dividend yield in the 6 to 7% range. In today's market, that is a huge income stream. This is the dividend shield. The bull case is essentially this. An investor gets paid a very handsome 6 to 7% yield to wait for management to fix the problems. So we have a potent bear case and a defensive bull case. To synthesize our analysis, we need to weigh these conflicting forces. After our deep dive, our concluding analysis is this. Singapore Airlines is a company in a stalemate. The stock presents a classic case of a value and yield play under siege. The company's foundational strengths are compelling, but the negatives from Air India and industry-wide profit pressure are severe and immediate. For the stock's outlook to improve, the market would likely need to see clear evidence on two fronts. One, a fix for Air India, proof that the financial bleeding has been stopped. And two, an end to the price wars, evidence that passenger yields have stabilized. Until there is clarity on these two critical issues, the stock's future remains highly uncertain. So, what kind of investor might be drawn to a stock with these specific characteristics? The profile would likely be that of a high-risk, income-oriented, long-term investor. This type of person would need a time horizon of at least 5 years and a very high tolerance for volatility. Their primary motivation would be capturing the high dividend yield as compensation for bearing significant risk. Conversely, investors who prioritize near-term growth or capital preservation may find the current headwinds and uncertainties too significant. For many, the sky is ahead for Singapore Airlines may appear far too stormy, suggesting a wait-and-see approach is a prudent way to manage risk. So what do you think? Is a 6 to 7% dividend yield juicy enough to ride out the storm? Or is the Air India investment a deal breaker? Drop your thoughts in the comments section below. And if you found this deep dive analysis valuable, please hit that like button and subscribe to the channel for more analysis. Thank you for watching.